Imagine buying a home in 2021 at the height of Canada's housing frenzy, paying top dollar, only to see its value drop by $150,000 in just 3 years. That's the reality for many homeowners in Toronto, Vancouver, and beyond, as Canada's once red-hot property market enters a new phase, cooling, correcting, and recalibrating. But is this a gentle, soft landing that will stabilize in 2026, or the start of a deeper decline? And how does Canada's situation compare to other global markets like Australia, where home values continue to climb? Let's break down the latest market forecasts, the numbers behind the drop, and what it means for buyers, sellers, and investors in the months ahead. Forecast: a national dip, not a freefall. According to both Reuters and the Canada Mortgage and Housing Corporation, CMHC, national home prices are projected to fall around 2% in 2025, before leveling out in 2026. While a 2% drop may not sound dramatic, it comes after 2 years of sustained cooling, meaning this is part of a multi-year slowdown, not just a short-term hiccup. Toronto, expected to see a 4% drop this year, making it one of the hardest hit cities. Vancouver, forecasted to fall about 2%, though luxury properties may see steeper cuts. Rest of Canada, most regions will see modest declines, with smaller cities and some prairie markets holding steadier. What's driving this? U.S. trade tensions. Political and economic uncertainty between Canada and the U.S. is denting buyer confidence, especially among international investors. High debt loads. Canadian households are among the most indebted in the world, and mortgage stress tests remain a hurdle for many. Lingering rate impacts. Even though mortgage rates have dipped slightly from 2023 to 2024 highs, affordability is still stretched. The $150,000 drop since 2022. In early 2022, Canadian home prices were at record highs, fueled by ultra-low interest rates, pandemic-driven migration patterns, and a rush to buy before costs rose. Fast forward to mid-2025, the average Canadian home has lost roughly $150,000 in value since the peak. In Toronto, that translates to a 20% decline from early 22 prices. Even with recent rate cuts, buyers remain cautious, and bidding wars are now the exception, not the rule. This isn't just a big city issue. Secondary markets that boomed during the pandemic, like Kelowna, Halifax, and smaller Ontario towns, have also seen significant corrections as remote work demand has normalized and urban migration patterns have reversed. Why Australia's market is still booming? The contrast between Canada and Australia is striking. While Toronto's housing market has been cooling for 3 years, Sydney, once on a similar price trajectory, has continued to rise. Why the difference? Tighter supply in Australia. Australia's housing construction has not kept up with population growth, creating persistent shortages. Different mortgage structures. Australian mortgage often reset every few years, but the market has been more shielded from the steep rate shock seen in Canada. Investor behavior. Domestic and foreign investment in Australia's property market has remained robust, buoyed by immigration and confidence in economic stability. For Canadian policymakers, this contrast raises questions. Is our correction a necessary affordability reset, or are we overcorrecting due to high borrowing costs and overly cautious lending rules? The role of lower mortgage rates. One bright spot in the 2025 outlook is that mortgage rates have been edging down, offering some relief to buyers. The 5-year fixed rate is now in the low 5% range for qualified borrowers, down from over 6% last year. This has sparked renewed interest in some markets, but the recovery is slow because wage growth hasn't kept pace with housing costs. Industry experts believe rates could dip further if inflation continues to cool, which might encourage more buyers to re-enter the market in late 2025. Regional winners and losers. Not all Canadian markets are reacting the same way to the national slowdown. Under pressure, Toronto and Vancouver. Larger declines due to high prices, heavy investor activity during the boom, and tougher affordability constraints. Ontario cottage country. Pandemic-driven demand has reversed sharply, leading to significant price corrections. Holding steady or growing. Calgary and Edmonton, Alberta's housing market remains more balanced, with modest declines or flat prices in 2025 due to strong in-migration and better affordability. Atlantic Canada, some smaller cities like Moncton and Charlottetown still see modest price growth, though at a slower pace than 2021 to 2022. What this means for buyers and sellers: for buyers, the correction is a double-edged sword. Pros: lower prices mean better entry points, especially in overheated markets. Cons: higher mortgage qualification thresholds and lingering uncertainty may still limit access. For sellers, pricing realistically is critical. Homes that are priced 5 to 10% above current market value are sitting unsold for months, while competitively priced listings are moving in weeks. The bigger picture: stabilization in 2026. CMHC's forecast for stabilization in 2026 suggests Canada is not heading toward a housing crash, but rather toward a period of price normalization. The idea is that after a steep climb from 2015 to 2022 and a correction from 2022 to 2025, prices will find a sustainable middle ground. This could make housing more affordable for first-time buyers provided mortgage rates continue easing. Final thoughts. Where do we go from here? Canada's housing market is in a reset phase, painful for some homeowners, but potentially healthy in the long run. Prices are dipping, not collapsing. Lower mortgage rates could slowly restore confidence. Government housing initiatives, if executed well, could help ease long-term supply issues. Still, the contrast with Australia is a reminder that markets can take different paths even with similar starting points. Global investors, policymakers, and everyday buyers are watching closely to see whether Canada's soft landing holds or if further turbulence lies ahead. What do you think? Is Canada's market correction a blessing in disguise for affordability or a warning sign of deeper trouble? Share your thoughts below. I'd love to hear your take.